The RBI's unexpected decision is likely to have a significant impact on the Indian economy and financial markets. While it may lead to short-term fluctuations, the long-term effects remain to be seen. Investors will be watching closely to see how the government and central bank manage the economic situation and what measures they take to ensure stability and growth. This is the first time since May 2022 that the RBI has not made any changes to interest rates, and it's being seen as a sign of confidence in the Indian economy. While leaving the rates unchanged, the Monetary Policy Committee, MPC, also retained its stance of focusing on withdrawal of accommodation. This means that the RBI will continue to monitor the economic situation and make decisions accordingly. Governor Shaktikanta Das stated that the decision to pause the rate hike was for this meeting only and that the central bank would be ready to act should the situation so warrant. What is monetary policy? In simpler terms, monetary policy is a set of decisions made by the central bank, Reserve Bank of India, about how much money should be available and what interest rates should be. This means that the Reserve Bank of India, RBI, decides how much money is available in the economy and sets the interest rates that people have to pay to borrow money. The goal of monetary policy is to help the economy grow while keeping inflation stable. The aim is to support the growth of the economy while keeping prices stable, so things don't get too expensive for people to buy. How does monetary policy work? Central banks like the RBI control monetary policy to keep the economy stable and prevent inflation from getting too high. They use different tools to achieve this, including changing interest rates, the amount of money available, and buying or selling bonds. To do this, the central bank can change the interest rates that people have to pay to borrow money, increase or decrease the amount of money available, and buy or sell bonds. If inflation is too high, the central bank may raise interest rates to encourage saving and discourage borrowing. When prices are getting too high, the RBI may increase the interest rates people have to pay for loans to discourage borrowing and encourage saving. If inflation is too low, the central bank may lower interest rates to encourage borrowing and spending. Conversely, if inflation is too low, the RBI may lower interest rates to encourage people to borrow and spend money to stimulate the economy. Lowering interest rates can make it easier for businesses to borrow money and invest, increasing the demand for goods and services. By making it cheaper for businesses to borrow money, more investments can be made, which can increase the demand for goods and services. Raising interest rates can reduce inflation by making it more expensive for consumers to buy things when borrowing costs are high. When interest rates are high, consumers have to pay more for borrowing money, which makes it more expensive to buy things, reducing the demand for goods and services. Surprise move by RBI. How it will affect the Indian stock market. 1. RBI has surprised markets by not changing the repo rate, which remains at 6.5%. 2. This is the first time since May 2022 that the central bank has not made any changes to interest rates. 3. The decision goes against the predictions of 49 out of 62 economists, who had expected the RBI to lift its repo rate by 25 basis points to a 7-year high of 6.75%. 4. Some sectors, such as real estate, automobiles, and financial institutions, are expected to benefit from this decision in the near future. 5. Monetary policy is a set of decisions made by the central bank to control the amount of money available in the economy. 6. The central banks raise interest rates to discourage borrowing when inflation is too high and lower them to encourage borrowing and spending when inflation is too low. The market moves. The RBI's decision to keep rates steady was well received by investors, with benchmark indices rebounding and the Nifty 50, Sensex, and Nifty Bank Index all seeing gains. The RBI decided not to increase interest rates in India, which pleased investors. Nilesh Shah of Kotak Mahindra Mutual Fund compared this decision to a skilled move made by Sachin Tendulkar, who was known for his ability to hit the ball in any direction he wanted. Some sectors, such as real estate, automobiles, and financial institutions, are expected to benefit from this decision in the near future. The Reserve Bank of India, RBI, has surprised markets, causing the Indian rupee to decline against the US dollar. Following the announcement, government bond yields dropped significantly, with the benchmark bond yield crashing to its lowest point in nearly 7 months. The 10-year benchmark bond yield dropped to 7.1469%, its lowest since September 15. Prior to the decision, The yield was at 7.2857%. The RBI's decision to keep interest rates unchanged is an important step for the Indian economy. It shows that the central bank is taking a measured approach to managing inflation and growth, which will help to stabilize the markets and boost investor confidence. Additionally, the fact that the RBI is open to taking action in the future if necessary is a reassuring sign for investors who are looking for stability and predictability.